Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us today. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. U.S. President Donald Trump is in China for a multi-day trip, including a meeting with Chinese President Xi Jinping. This marks the first visit to the country by an American president in nearly a decade. Trump says his priority is trade, not the war in Iran. He was joined at the last minute by NVIDIA CEO Jensen Huang, who is accompanying other executives, including Elon Musk and Tim Cook. We are watching shares of Equinox Gold as well as Orla Mining today. Equinox is buying Orla in a cash and stock deal that values the miner at $5.1 billion US. Acquiring the Vancouver-based company will give Equinox access to assets across the Americas, including its flagship mine in Mexico. Equinox CEO Darren Hall says the deal will see shareholders benefit from the growth that both companies bring.
Provides a really unique opportunity for both sets of shareholders as we see both companies ramping up production to be able to come together. We get a very symmetrical deal going forward. Both sets of shareholders will benefit from the growth that Equinox brings, Orla brings, and together we accelerate into being a senior producer much more quickly than what we would have done as a part.
Shares of Finning International are getting a boost today, up nearly 5%. That after the equipment dealer posted profit in its latest quarter that beat estimates and also saw a surge in equipment rental revenue. Finning says the results were driven by higher construction activity and product demand in Canada. New equipment sales in Canada were also up 23% compared to the year before. And taking a quick look at the markets, you can see the TSX still in the red right now. It's being dragged down mostly by the tech sector. It's off by more than 2% right now. South of the border, it's been a bit all over the place, and that bit all over the place continues. S&P 500 now up by 0.18%, and the NASDAQ is up by 0.68%. Okay, American markets are under pressure today with hotter than expected inflation data fueling concerns that the Federal Reserve may keep interest rates elevated for an extended period. Yet, despite the renewed uncertainty, our next guest remains decidedly bullish, arguing that tech leadership is far from over and that the sector will continue powering market momentum. For more on the tech sector, we're joined now by Jeff Buchbinder, Chief Equity Strategist at LPL Financial. Jeff, thanks very much for joining us.
Good to be with you.
All right, what's your main reason for the optimism about tech?
It all starts with earnings. We've been referring to the earnings from tech as an avalanche. Tech earnings are growing 50% in the first quarter, and we expect 30 to 40% growth in tech earnings over the next several quarters. Of course, we know why that is. It's the AI investment that is driving significant earnings growth. And it's not just the strong growth, it's the revision to the expectations in that growth. So, at the start of the year, we were looking at maybe 10, 12% earnings growth for the S&P 500. Now those expectations are north of 20. About half of that earnings growth is coming from the Mag 7, the mega cap techs. And we don't think it slows down. Capital investment this year is expected to be around $725 billion from the big AI hyperscalers building out these capabilities. Next year, we could see numbers of around $1 trillion. The numbers are just massive, and they're enough to push earnings higher, significantly higher, and drive economic growth as well.
There was a lot of concern about that, the CapEx that was going on, and the way it's grown and grown and grown, and now you're saying maybe $1 trillion next year. Obviously, you're seeing results, and others are seeing results that they like from that spend.
Yeah, no doubt. A lot of folks are comparing this period to the late 90s. We've been doing the same thing. There are certainly some similarities and some differences. I think it's important to keep in mind that we're still early in the AI build out, right? We don't know how much of the spending is going to prove to be wasteful. We're in the phase where the build out is happening. And certainly we're more optimistic about this spending being productive than the spending that we got in the late 90s. Of course, the telecom equipment that was put in place to build out the infrastructure of the internet was largely wasteful. This time's very, very different. It's also important to keep in mind who's doing the spending, right? A lot of the spending is coming directly from cash flow from these massive tech companies with the strongest balance sheets anywhere in the world. It was very different in the late 90s. We haven't seen this sort of tangential consumer website type model, right? A lot of those companies certainly didn't make it. Here, we're not even to the second phase. We're doing the build out. We're optimistic about the build out, that it's going to be productive. We may have some waste. Clearly, there are risks that this does not work out quite as much as maybe the optimist would say, but we think it's too early for the market to worry about that. This spending's coming through, and you're starting to see some productivity gains. You're starting to see use cases from companies using AI to be more productive, drive higher profit margins, and drive growth.
And you're not concerned, I mean, is there a concern that data centers could somehow become outdated quickly if some new technology, quantum computing or something comes up, that they might not need these massive data centers, things like that? Is there a concern for that?
There are a lot of risks in this build out. Certainly that is one. The technology will have to continually be updated. We have to essentially trust these big players that at this point they know what they're doing. Again, we're actually seeing the demand for the AI compute come through as it's being built. This is not, if you build it, they will come. They have already come. They have arrived. The demand is there. These companies are essentially selling as much as they can make available. We have constraints, of course. The power constraints are real. The concerns about putting data centers in certain states that have already pushed back, that, of course, is a concern. So this will slow the cycle. We're already basically 4 years in, which maybe puts us at 1997 if you want to make the comparison to the late 90s. A slower cycle actually might be a safer cycle. So perhaps these constraints reduce the amount of waste, allow the economy to adjust to the strains on labor. Certainly, we would not be surprised if there's a little bit of an uptick in unemployment as some jobs are displaced. This cycle is going to run, we think, for several more years. What you want to watch for, in addition to those capacity constraints, are signs that maybe this spending won't happen, right? Will the revenue come through to support the demand? Will the cash flow be available to actually make these investments? We're not seeing anything like that at this point, but certainly we'll be keeping an eye on it.
And software, where do you see this fitting in? Where's moving ahead? It's been taking a beating.
Yeah, we'd be careful with software. At LPL, we are overweight tech, continue to recommend the tech sector, but we prefer to be in semis and hardware over software. Now, within software, there are certainly some opportunities. Some babies have been thrown out with the bathwater. If you can identify the software players that are really ingrained, mission critical, cannot be displaced by AI, and there are certainly some of them. IT security is certainly one place to look. Those names should do fine, but right now we'd be careful there. Focus on the hardware, focus on the chips. That's really where the spending is going right now.
And with your asset allocation, you're also underweight now on fixed income?
Yes. Yeah. Part of the reason why we're overweight equities here is because bonds don't look particularly attractive. I mean, we still have a little bit of an inflation problem, as we're all aware. We'll see how long the conflict in Iran lasts and how long it takes oil to come down. The Fed's probably on hold the rest of the year. That's not a great environment for fixed income here. We don't necessarily see a ton of upside in equities, given where valuations are. but we've got so much more earnings power right now than we thought we'd have at the beginning of the year. Even if rates and inflation put a little pressure on multiples, we still think you can support maybe an S&P 500 200 or 300 points above where we are right now.
Okay, we have to wrap it up there, Jeff, but thanks very much for joining us.
Thank you.
Jeff Bookbinder is Chief Equity Strategist at LPL Financial. And coming up, Equinox Gold is buying Orla Mining in a cash and stock deal valued at $5.1 billion US. We heard from the CEOs of the two companies. That interview is up next. Equinox Gold is buying Orla Mining in a cash and stock deal valued at $5.1 billion US. The combined company is expected to produce about 1.1 million ounces of gold annually. For more, we sat down earlier with Darren Hall, CEO and Director of Equinox Gold, and Jason Simpson, President and CEO of Orla.
This at-market combination, it's a zero cash deal, it's an all-share deal, provides a really unique opportunity for both sets of shareholders as we see both companies ramping up production to be able to come together. We get a very symmetrical deal going forward. Both sets of shareholders will benefit from the growth that Equinox brings, Orla brings, and together we accelerate into being a senior producer much more quickly than what we would have done as a part. So that's the value proposition in a nutshell. And
when we're talking about gold production, the combined company is expected to produce 1.1 million ounces of gold annually, but you see a clear path to 1.9 million ounces. So, Mr. Simpson, maybe you want to take this one. Can you tell us about your strategy for reaching that goal and maybe a timeline as well?
Yeah, certainly. Both companies, Equinox and Orla, had growth platforms built into our individual companies. And as Darren characterized, what this combination does is enables us to accelerate that transition into an over million ounce a year producer and then begin the growth through our combined portfolio in sequence to get us that 1.9 million ounces. And so we have clear visibility on the sequencing of those growth projects that'll propel us towards 2 million ounces and all the while operating our 6 assets to produce the first 1.1 million ounces beginning this year.
From a shareholder perspective today, though, I mean, looking at this merger, why is this better than staying as two separate companies, especially for Orla investors who may feel that they're being diluted? Mr. Hall?
Yeah, maybe I'll pass it to Jason to answer from the Orla perspective.
Yeah, our perspective on this is we see a greater value proposition in the combined company, not only the immediate platform that we have becoming a senior gold producer and the second largest producer of Canadian gold, but also the growth that Darren and I will unpack in the coming years, starting in Newfoundland, then in Nevada, followed by California and the other assets in our portfolio. And so the growth and value creation proposition of the combined company far exceeds any conversation about today's premium. We know that we've got the support of our major shareholders in this transaction, and we're hopeful that the remaining shareholders will also see the value in what we've created as a combination. They saw the value in what Orla had in our growth platform, but had to be patient with its delivery over the next 5 to 6 years. In this situation, they will not only get the assets they're familiar with at Orla, but get access to the great assets that Equinox has, and all of that creates a value pathway on a much more accelerated basis and amplifies the potential value creation we can deliver to both sets of shareholders.
And if there's one thing I can add to that, it will be that, we're not increasing the jurisdictional complexity associated with this transaction. We're operating in the same place as we are today. We're putting these things together so that the opportunities that will exist to be able to leverage off the strengths that we both have in those regions will be significant and will further add to the value that we can surface from this transaction.
This is probably a question for the Orla side as well. Did you look for any other offers before this deal?
I would offer that we are very plugged into to the entire mining scene and consider things frequently. And then when we became focused on this transaction, we of course spent a number of months making sure that we did significant due diligence. And so I would offer that we're all aware of each other. Darren and I know each other and have looked across the market at each other's growth. And I'm pretty impressed with what Darren has done through Calibre and now Equinox. And I expect he's equally satisfied with what I've done at Orla. And so it just seemed to be a very natural fit, as Darren described. The geographic symmetry of our independent companies makes for a very straightforward story and limited geographic complexity in the combined company. And then finally, both of our teams will be able to merge and deliver the production and growth that Darren and I have talked about.
Both Orla and Equinox based out of Vancouver, so two Canadian companies. Was it important to you both that this is an all-Canadian combination rather than a foreign takeover?
No, I think that, again, the value proposition, as we've outlined, is clear. The benefit from this transaction is the synergies we've discussed and the symmetry that we've discussed. But, we come out of the gate here as the second largest producer of Canadian gold, with a great profile to increase that base as well as we continue development of our North American platform. And we look forward to the future of being, north of 70% of our mining NAV coming out of the US and Canada. So, positions us really, really well.
But the fact that you're an all-Canadian combination, right, when we're seeing so many Canadian companies being taken over with foreign ownership, that wasn't important at all?
It's a consideration, of course. But, again, we're proudly Canadian. But our first responsibility is that we're a financial instrument to create shareholder value. And we do that through share price appreciation, and we see as a clear pathway to do that. And leveraging off our Canadian base is a critical component of that, for sure.
Okay, Mr. Simpson, I'm not sure if you want to take this next one. Post-merger, depending on how long this takes, how does your asset mix change in terms of jurisdiction risk, mine life, cost profile, all of those factors?
Yeah, so let's speak first about some of the timing that you questioned. We anticipate closing this transaction in the third quarter, so that's the timeline people should anticipate with the necessary regulatory and court approvals, and at which point we'll be combined. And what changes is that we have a larger platform, but really in the same jurisdictions. As I described, we now have multiple mines in Ontario, one in Newfoundland, so that Canadian platform anchors with those three great assets. And to the mine life question you spoke about, the Equinox mines in Canada are just getting ramped up and have very long mine life. And then the combined company has resources not only in Canada, but the United States and Mexico and our other jurisdiction, Nicaragua, to over 23 million ounces of reserves that we'll be able to access and create further value. So everything is an improvement in the combined company, mine life, free cash flow, growth profile, and an instantaneous production of over 1 million ounces. And yes, we are clearly a North American-focused gold senior company now. Okay,
so and as you say, this deal expected to close in the third quarter. I believe it does require Mexican competition authorization as well. Correct me if I'm wrong on that, but how confident are you that timeline will be met? And is there a contingency plan in place if the approval is delayed?
Now, we don't see a significant risk in attaining the required approvals and closing here successfully in Q3.
Lindsay was speaking with Darren Hall, CEO and Director of Equinox Gold, and Jason Simpson, President and CEO of Orla Mining, about their merger. Coming up, today's market driver is with Bloomberg's Monique Molima. Time to take a look at today's market movers, and we are joined by Bloomberg Equities reporter Monique Molima. Monique, thanks as always, for joining us. We'll start off with EOS Energy, and things are looking good for them right now.
Yes, their shares are higher this morning after they reported first quarter earnings that beat on revenue as they continue to see some strength in their energy storage. But the big news for them today is that they announced a project with Cerberus Fund, Cerberus Capital Fund, which is a private equity partner. And with them, they're going to be working on battery energy storage. This is going to be an investment and development firm that is going to be vertically integrated and focused on the U.S. Battery energy storage has really been a focus with the growth of data centers and them needing more power and the ability to store that power. So this fund, which is going to use some of EOS's technology as well as some funding from Cerberus, is really expected to be able to capitalize on that demand.
All right, and of course, what's a great source of power to store in batteries? Solar power and Next Power looking good right now.
Yes, Next Power, their shares are quite a bit higher this morning after they raised their fiscal year 2027 revenue guidance on the strength that they are seeing in solar and in battery storage as well. The company also announced that they bought some of Zigger Corporation's power conversion assets, and this is expected to fuel their growth even further. Analysts are really positive on this acquisition. They say that this is going to help really advance some of the company's role in utility scale solar as well as the battery storage for data centers, and this is expected to provide even more upside, which they're already seeing from this raised guidance.
And it looks like it's lifting up some of its fellow solar stock companies.
Yes, across the board on solar, we're seeing them higher. Solar is an industry that has been kind of somewhat struggling earlier this year after the end of some U.S. tax credits. But with this strong outlook, it's really looking positive for the industry, and that's why we're seeing some of those shares higher as well.
All right, now we'll go a little old school, and Dow getting a bump.
Yes. So Dow, their shares are higher this morning after Argus raised their recommendation on the stock to a buy. They say that Dow has really seen kind of a reversal from some of the pressures it had earlier. In previous quarters, they were dealing with a bit of an oversupply, which was weighing on some of the prices they were able to get. And now it's the opposite. With the closure of the Strait of Hormuz and the disruptions in the Middle East, there's been a tightened supply of chemicals, and companies like Dow that have assets outside of those regions have been able to benefit and achieve higher prices because of this, and they're seeing Dow continue to benefit from this. And they also say that there's some other fundamental things happening at the firm. They expect that management is going to be working on cost cutting in the coming quarters, which should help earnings as well.
All right, we'll wrap it up there. Monique, thank you as always for joining us.
Thanks.
Bloomberg's Monique Malima. Shares of Finning International are getting a lift today. Adjusted profit came in 1 penny higher than estimates, but our next guest says it should be read as a beat. That's next. Shares of Boyd Group are taking a hit. The operator of collision repair centers reported adjusted profit in its most recent quarter that fell short of expectations, while same-store sales missed estimates. Boyd saw a net loss of nearly $8 million US, which it says was caused by acquisition and transformational expenses related to its Joe Hudson acquisition and Project 360. Boyd says the costs are expected to decline as integration finalizes. We are tracking shares of Algoma Steel. It's up right now, about 4.6%, 4.7 almost. Oh, it just jumped 4.8 now, after it posted a first quarter loss of close to $160 million, along with a drop in revenue compared to the year before. The Ontario-based steelmaker says it incurred more than $27 million in direct tariff costs during the quarter. Algoma attributes these changes to its transition away from blast furnace operations to its new electric arc furnace platform. Go easy. Well, more pressure on the shares there. The company reporting a bigger loss than expected and adopted a shareholder rights plan to prevent hostile takeover bids. The subprime lender has been grappling with losing money in its auto lending unit and writing down hundreds of millions of dollars worth of debt. The company says charge-offs will remain elevated up to 17.5% next quarter and will remain in the mid-teens for the full year. Boise says it remains confident it can return to strong credit performance eventually. Well, Fitting International is getting a lift today after the Vancouver-based equipment dealer posted adjusted profit that came in 1 penny above expectations. Our next guest says this metric should be read as a beat. Let's get more from Jonathan Goldman, diversified industrial analyst at Scotiabank. A penny is a penny. Why should we be liking this as a beat?
Yeah, we would say on the headline metric, it's likely more than 3 pennies. I mean, there was one estimate in there that's inflating consensus by 2 cents. Would be the first point. And I think the second point is the company incurred 9 cents a headwind of LTIP. So that's long-term incentive compensation. And that's actually tied to performance. So we would say this is a good problem to have. It's not 9 cents every quarter. It's a one-time, and it kind of reflects the strength in the business. So if you're looking at, the headline number probably should read bigger than a penny, and the underlying trends are actually really strong.
Let's look at the different markets. Canada, how did it do?
Yeah, so this is another reason why we've come out bullish after the print, and we think this is a great opportunity for investors to look at this stock after what we thought was a great print. 2 areas of strength, really. You mentioned Canada. What was remarkable there is the product support. This is the maintenance that they do on the trucks, and this is the business that really drives earnings. And this was up 13% year on year, and that was off of a 10% comp last year. So just massive strength. Their exposure is mostly to the oil sands, and they do some construction as well. This will typically track in line with end market activity, so production growth in the oil sands. The fact that it's almost double those levels is really a good sign for the quarters to come, and probably why investors should look at this as a pretty strong product support outlook.
Any potential headwinds in Canada? Any concerns?
We actually think it's the opposite, right? I mean, everything is working in their favor. The oil sands, what's good here, obviously the oil price is helpful, but this industry has gone, a massive wave of consolidation and kind of rationalization over the past few years. So there's no more boom and bust that we saw in 2014 and 2016. Everyone's deploying capital, reasonably returning it to shareholders. So we see stable activity levels. One positive surprise in the quarter was actually their construction business. That had been lagging. They were coming out of some, high activity levels. In 23 and 24, there was a lot of pipelines that were built. That end market seems to have rebounded and is actually improving. Then when you think about that in the context of defense tailwinds and nation building, the strong gold and copper prices, we really think the wind is at their back right now.
All right. And then outside of Canada, South America, the UK, Ireland, how are they shaping up?
South America, another success story. So we had gotten concerns heading to the quarter that they delivered a lot of mining trucks over the past 2 years. Miners look to address, the copper production there. So we had this sense that we may be up into tough comps and not fulfilling those, this year. What happened, and that did play out in the quarter, but they booked an order in Argentina. So Argentina has really been kind of this, stranded region for the company over the past 5 years. New government supportive policies, and they booked a large mining order in the quarter for a copper mine. It's run by Glencore, 20 trucks. That's a massive boost to the backlog, which set a new record. It should backfill any weakness in new truck deliveries this year. And what's amazing about that, it's not even the big award that we're waiting for. There's a large copper mine that's, undergoing planning and starting up Vicuña District. And we expect those awards to materialize later in the year, early next year. But this is a tailwind that goes out several years.
So no challengers anywhere for them?
No, I would say the UK has always been a little slow. It's, GDP-ish 1% growth. The story in the UK, and this is kind of, permeates the rest of the business well, is the data center. So Finning does supply power reciprocating engines, which is backup power for data centers. So their power backlog was actually up quarter on quarter as well. So that's another tailwind there. So UK is slower, but again, benefiting from this data center thematic.
Yeah, and just with the backlog, any concerns about, is it too big or is it something it feels manageable?
It's manageable. So as an equipment dealer, the main cost, to grow is inventory. We did see working capital increase in the quarter. Inventory is up. They're looking obviously to build that up and ahead of delivering on the backlog, but we see that as a positive sign and a leading indicator of growth ahead. And what doesn't actually hit the backlog is the product support revenues. So all these trucks that are going to be delivered now that were delivered over the past 2 or 3 years, those are starting to require regular maintenance. So we see this actually as the beginning of a long product support cycle for the business.
And any concerns about the adjusted? I'm just looking at some of the numbers. Adjusted EBIT margin, it contracted from Q1 in 2025 to Q1 in 2026?
Yeah, it's a good question. A lot of margin fluctuation will happen, mix. The more product support you do versus equipment, product support is higher margin. That will shift things around as well. And the other one that, we say inside baseball is mix within mix. Depending on the end market or the customer you're serving, it could be higher or lower product support margin. Mining tends to be lower. The customers are bigger. Construction tends to be higher margin. So we wouldn't read anything too much into that. And I guess the counterpoint to that is volumes are up in product support. So the offset is you're getting better operating leverage on the cost base.
All right. And adjusted ROIC dropped 50 basis points to 18.7%. Any concerns there with that?
It's funny. I've covered this stock for a long time, back to 2018, and we were talking about ROIC in the 12 to 15% range, and now we're quibbling over 50 bips when they're doing 18% plus. No concerns there, and I think this is actually a testament to the business able to earn high returns on capital through the entire cycle. We've seen oil prices, go sky high during COVID, and all the way down to 60 and now back again, and earnings just keep on increasing, and ROIC keeps on increasing through the cycle. So clearly a much better business, higher returns on capital, and structurally improved versus historical Finning.
All right, and moving forward, what opportunities do you see for it then?
Yeah, lots of opportunities. Again, I think the wind is really at their back. Gold prices are elevated, copper prices are elevated, oil prices are elevated, but the story there is more about end market stability. There's nation building, there's defense, there's opportunities to right-size the cost base and get leverage. They're building the backlog. They sold a small business last year. It was a refuel business on site. That should allow them to deploy more capital for organic growth and seed the truck population. And then, the big one would be data centers. They play in Alberta. There's a lot of talk there about gigawatts coming online and green light and projects there. Finning is a direct beneficiary of that boom in data centers. So we look for more things like that to materialize in the near term. Nothing crossed the finish line yet, but very positive commentary on the call about that.
All right, we have to wrap it up there, Jonathan, but thanks as always for joining us.
Thank you.
Jonathan Goldman, diversified industrial analyst at Scotiabank. Up next, Denison Mines is sharing more details about its uranium project with its first quarter results. We discuss more right after the break with the CEO. Denison Mines saw a loss in revenue drop in the first quarter, but both measures were narrower than the same time last year. Here to talk more about the Toronto-based company is David Cates, President and CEO of Denison Mines. And David, thanks very much for joining us today.
Oh, Roger, my pleasure to be on.
All right, looking at those numbers, you seem to be going in the right direction. Do you have reason for optimism? When do you see turning into the green?
Well, look, for our company, we're at a very exciting time. We've just started site preparation and early works for construction of our flagship Phoenix in situ recovery uranium mine in northern Saskatchewan, and that's our ticket to generating positive returns and meaningful cash flow for our shareholders. So right now, our focus is on investing, and you'll see that, of course, in our financial results as we are investing in the construction of this new mine, and it marks the first new uranium mine that's been approved for construction and has started construction of a large scale in Canada in over 20 years.
And is everything on schedule still with it for mid-2028?
Well, with our permits being received in February of this year, the final permits necessary to start construction, and our quick decision to make the final investment decision, and then our ability to mobilize to site our integrated project team and start with that early works and site preparation program, we are still targeting to be in first production by the middle of 2028. And that's pretty unique owing to the mining method that we're working with, that we can have such a short construction period.
And what's different about that, the mining method?
Well, we're using in situ recovery. And so this doesn't require us to access the ore body via a shaft or a pit. and it doesn't require us to build a big mill. We're using a series of borehole wells that'll be drilled from surface, and then we'll be injecting and flowing through the ore body a mining solution that'll dissolve the uranium in its position and then recovered back to surface through that same well network. And so owing to that, many of the time-consuming and costly aspects of building a conventional mine are bypassed. For example, we won't even have a conventional tailings facility that we need to build, and our process plant on surface won't be milling or crushing or grinding any rock. It'll just be precipitating the uranium out of the recovered solution. And so all of that makes the construction of our project much more simple, lower cost, and we can have a shorter timeline.
And this has been used elsewhere. What kind of success have they had with it?
Well, in situ recovery is the number one mining method for uranium recovery globally. It's being used in the United States, in Australia, and Kazakhstan, and other countries. But this will be the first deployment of the mining method in Canada for uranium mining.
All right, let's talk a little bit about McLean Lake and the joint venture operations there. How are things moving with the Sabre mining method ramp up?
Right. So at McLean Lake, we're a joint venture partner with one of the global leaders in our sector, Orano. This is a company that's vertically integrated in the fuel cycle, a nuclear fuel cycle, and they're an excellent operator, very safe and very credible. Happy to be their partners at McLean Lake. We've developed together with Orano over the last 20 years a patented mining method. It's called Sabre, stands for Surface Access Borehole Resource Extraction. And what it allows us to do is excavate the rock, so actually pull out the rock from a subsurface cavity, but do that from surface without having, again, to build a shaft or open a pit. And the mining method was commissioned, or the mine itself was commissioned last year. We achieved commercial production in the second half of last year. And we will be resuming production at that mine later this year. It's a bit of a campaign mining program at this stage. And so work early this year has been focused on resource confirmation drilling. And then later in the year, we will be transitioning into, again, excavating mine cavities and processing the ore. And the hope is that we'll be able to transition into a continuous mining operation over the next several years.
All right. And I believe you're sitting on about, is it 2.2 million pounds of U3O8? Is that right?
Well, the company had around 1.85 million pounds in uranium inventories and holdings at the end of the first quarter. And that's an important part of our balance sheet, gives us great strength as we move through financing our Phoenix project.
Are you going to be, I was going to ask, do you see a sell-off in the future of some of that then?
Yes, we acquired most of our uranium in 2021. We paid just under $30 US per pound. It was a long-term strategy to support the Phoenix project construction financing. And so now that we're into construction, that phase with Phoenix, we are drawing down and placing our uranium into the market. We've reported some of our recent sales, and I think the investors and the uranium market can see that we're being very responsible with our sales. We sold around 500,000 pounds, I think it was 550,000 pounds in the first quarter for deliveries over the next, call it 12 months, at a price just under $100, realizing around $99 US per pound. Right now, the spot price is in the mid-80s, so you can see that we're being quite savvy in the way that we're monetizing that physical uranium.
All right. And how are things going with that, the deal with Kosa Resources, that 70% interest in the 3 properties there? How is that working out?
Well, Kosa is one of our Team Denison investment companies. They're doing an excellent job working a portfolio of projects that we've invested into their company, including the Murphy North property in Darby. Denison owns a large shareholding in Kosa, just under 20%, and we're the direct partner on those properties. Kosa has an excellent technical team, and they've had some great initial results at Murphy North, as well as some encouraging results at Darby. And, you know, our strategy for growth at Denison is to work our own exploration portfolio, but it's also to amplify our exposure to discovery by investing in companies like Kosa. We're also invested in a company called Sky Harbor Resources, which has a project portfolio package that is adjacent to our Wheeler River property, and a company called Foremost Clean Energy, which has an option on 10 of our properties in the eastern part of the Athabasca Basin.
All right, just one last. You have 3 new board members. How are they fitting in? Where do you see their strengths being used?
Yes, so we also had our annual general meeting yesterday, and our board members were all reelected. Excellent rates of support. We have a board that has been recomposed over the last several years. And maybe I would just call out the caliber of some of these directors that we've been able to attract as part of a board rejuvenation program. Last year, we added Wes Carson, who is senior executive at Wheaton Precious Metals. We also added Ken Hartwick, who's recently retired from being CEO at Ontario Power Generation. And we also have a board member that's sponsored or appointed by KHNP, Korea Hydro Nuclear Power, which is one of the company's largest shareholders, and they operate all the nuclear power plants in South Korea. So quite a high caliber additions to our board, building on top of an excellent board that we've had in place for several years now.
Okay, we have to wrap it up there, David, but thank you very much for joining us.
Thanks, Roger.
David Cates, President and CEO of Denison Mines. Coming up, we'll look at a new study that suggests there's a gap between what kids understand about money and what they actually do with it. It's after the break. How confident are your kids with money? Today is Talk with Our Kids About Money Day, an initiative encouraging parents to help their kids build real-world financial skills. For more on how to raise financially confident kids, I'm joined by Vanessa Bowen, founder of Mintworthy. Vanessa, thanks very much for joining us.
Thanks for having me, Roger.
Just how good are kids with money? Are a lot of kids struggling with it? We almost feel like, well, we look and go, you're too young.
Well, it's interesting. So this recent study that was conducted by Mayo shows that although 90% of parents are actively talking to their kids about money, only 9% of parents strongly feel that their kids could be financially independent when they leave home. So we're having conversations, Roger, but there is a gap between this practical knowledge of how to actually handle and manage money.
And when should you start with kids? Or is it ever too early?
Personally, I don't think it is ever too early. Yes, maybe your child may not be able to understand conceptually what you're talking about, but I think once we have these conversations and start having them as soon as possible, kids start to feel more comfortable talking about money. They feel like money conversations are normalized. So I don't think there's a specific age to start. I think the sooner the better.
And what do you focus on when you're talking to them? What's key to tell the kids what they need to know?
Yeah, such a great question. I think the key is to have open conversations and making these conversations almost like everyday ones where they're not, overwhelmed or anything like that. And that's actually interesting because in this actual study by Mido, 1 in 5 parents kind of feel that they shouldn't have these conversations with their kids because they feel like it's going to cause their kids stress and overwhelm. And so to answer your question there, if we make the conversations easy, if they're just like low pressure conversations, then I think this is what helps kids to feel comfortable around money. And one of the things that Mido actually does with their app is that they allow kids to actually spend their own money, and then parents get the notification so they can actually bring these transactions to their kids to have these conversations.
And when you say keep it low key, how would you approach, I don't know, paying the bills or debt? You have some debt, a mortgage. How would you explain that to a younger child, or not a younger, say 12-year-old?
Yeah. So I have a little bit of a lens on this because I do feel that you should tell your kids some things, but it doesn't have to be everything. And so one thing I always recommend is, set aside 5 to 10 minutes every week and discuss a savings goal or spending as a family. Doesn't have to be the mortgage, doesn't have to be the debts. It could be the hydro bill. It could be the water bill. Things that kids relate to and understand based on the age that they're at, but having these conversations be natural to where they're at in their age group, and then increase those conversations, of course, over time.
And has it been made better or more difficult, first with AI, but first with just credit cards and swipes and taps, so they don't ever actually see the money in their hands?
Yeah, that's such a great point. There is definitely that disconnect between that tangible feel of money, especially these days. You're right. Everything is tap, tap, tap. But I don't think that takes away from the learning ability of kids to understand how to manage money. And the more that we allow them to experience it, even if it is a tap, where they can experience whether it's saving, spending, earning, they get to have these real life money moments that still teaches them, do I spend now? Do I spend later? It teaches them about opportunities. It teaches them about mistakes as well. But all of this comes together to really create their experience around money.
All right, what do you think of Ontario's mandatory financial literacy test for grade 10? Is it working? Are there things that can be changed in it? Is it needed? It sounds like it's needed.
I do feel like it's needed. And this is actually what we saw in the survey conducted by Mido. The education is there. So I do think we have to start with the education. The gap then becomes when we take that education out of school and bring it home to those practical applications. This is where something like the Mido Smart Spend Card allows kids to actually spend their money so they get to learn from these real life money movements. So I think we need both. We need the education, but we also need the practical knowledge and actual application of money as well.
Is this something that could be done earlier too, do you think?
Well, I think it depends on what age. I think, starting at least with a 5 or 6 is definitely like where we want to prefer to start. And that's where Mido has their app that actually starts kids at that age. So I think around 6 is definitely like the ideal. Before that, have the conversations. They might not understand everything, but it doesn't mean we don't get to start that talk around, the dining room table.
All right, and we're almost out of time, but what is the one thing that parents could do right now to get their kids on track with this? One quick.
Yeah, such a great question. I would say have them practically use money, whether that is with using something like the Mido Smart Cash Card, but practically spend, practically save, get them to experience money in a real life situation.
All right, we have to wrap it up there, Vanessa, but thank you very much for joining us.
Thank you so much, Roger.
Vanessa Bowen is founder of Mintworthy. Market Call is coming up next. Today on the show, we have Nick Mersch. He's a portfolio manager at Purpose Investments, and we'll be taking your questions on technology stocks. And that is it for Morning Markets. Thanks very much for joining us. We'll see you back here tomorrow.